Hello, hello. We're on week 5 module for investments, and so we'll be working through bonds today. We'll be spending just a short amount of time today going over 3 different PowerPoints. And so go ahead and start my share, and then we'll get going. Not only will we be talking about bonds, but we'll also be talking about mutual funds and ETFs. So we'll work through this one first, just trying to learn about the characteristics of bonds and what they are. As we talked about in our last module, bonds are an example of a debt obligation. And so from the investments perspective, we're looking at if you want to invest in bonds, here are the things that we need to know. So there you go, there's your bad joke. We're talking about debt instruments generally conceived to be a safe investment, a way to loan large money to large institutions and receive interest as yield, not James bonds. Barry Bonds or old baseball fans would know Bobby Bonds. So we're going to use these terms. The cost of investment is the principal. Interest is the price paid for borrowed amount. That's usually a fixed process. So it's equal periodic return normal payments over the course of the loan, kind of like what we talked about in the time value of money are annuities. And then maturity is the time when the bond comes due, the principal paid back to investor. There are different types of bonds that do slowly pay back principal over time, but that's lesser known than those normal common ones. So it helps to understand the language. Bonds are known as debt securities, fixed income assets in the world of investing. Our coupon is those payments that are paid out to bondholders. A current yield helps us understand what the APY is on it, and its yield to maturity though is different sometimes because it's a yield if the bond is held for its lifetime. So we find just like in the stock market, there's a bond market out there. So yeah, you can buy newly issued bonds, but you can also go out and buy bonds on the market that had been issued, and so that's a secondary market. And at that point, you could understand it's different between current yield, yield to maturity, and so forth and so on. Defaulting is just basically a term that means that a company's in trouble, they're not able to pay on their debts, you know, and I say company, but when we talk about bonds, we should also talk about governments and municipalities and states, because all of those systems are run on credit nowadays where, you know, agencies, governments, everybody will go out, issue bonds to pay for you know, the next big bill coming due, or even sometimes projects. The credit rating helps us understand basically those bonds ratings. And so you have the Moody's, you have S&P, and a few others. They go out there and give them different ratings we'll talk about. And sometimes bonds are callable, which is basically written into certain types of corporations to help pay early on bonds, cancel the debt at that point, where they pay you back all the principal. So here's the different types of bonds you have. The garden variety of corporation bonds, governments, note the term there, US Treasuries are divided into 3 categories: bills maturing less than a year, notes maturing 1 to 10 years, and then you actually have bonds maturing in 10 plus years. But then you have all these other different classes and categories as well. It should be noted, junk bonds are a little different. Any class of these corporation government bonds could be junk if they are lower than I think a B minus or a C range, basically meaning that they're high risk. Those agencies offering those bonds, those entities offering those bonds could very easily default. A typical bond investor is usually a person who wants to play things safe. They're concerned about the market and where it's heading, and want to make sure that their investment, you know, is going to pay out equally and evenly throughout the term of that investment. So the idea of that risk is, you know, mitigated a little bit more less than if you invest in things where you see the roller coaster ride of the change in asset values.